Welcome. My name is Gina Tubertini, and I am the Director of Sales Training here at First Home Mortgage. I'm thrilled today to be joined by our resident economic expert, our VP of Capital Markets, James Baublitz. We were blessed to have James join our leadership team a little over a year or so ago now. And James has over 15 years of capital markets experience covering everything from trading stocks and bonds to mortgages. So he's certainly run the gamut in terms of his career. Prior to joining First Home, James spent the last 10 years of his career with a fintech company called Compass Analytics, where he headed up the product management and strategy for Compass Analytics' flagship software offering called Compass Point. So Compass provides risk management and strategic advisory services for 130 lenders nationwide, including almost half of the top 50. James also teaches classes on capital markets for the Mortgage Bankers Association and has been featured on numerous panels throughout his career at the MBA's national conferences. So, James, again, super excited to have the opportunity to spend some time with you today. Welcome. Thank you for joining me.
Absolutely.
I can't wait to sort of dig into this with you. You know how I'm kind of a geek about these things. I'm excited to have the opportunity to, just share your knowledge today, with our team here at First Home. And then, our thought was that, perhaps this might be something that they may want to share with our business partners or even, with our valued borrowers that may be trying to figure out, what the economic headlines mean and how that affects their lives. And something that I certainly believe to be true and learned in my career while I was originating is, we as humans, we will take action when we feel educated, because then we feel empowered to make decisions that we feel are in our best interest. We hold back when there's fear. We hold back when there's anxiety. We hold back when there's some element of emotion that is a perceived negative. So what we want to do here is we just want to shed some light today. We want to provide some education so that you can gain a greater level of understanding and clarity as to what is happening presently, and maybe a few things to expect and guidance to empower you to take that action as it relates to your finances and things you wanted to do in your family's future. So, James, I'm going to dig right in here and start with sort of the crux of the conversation, and that explain to our viewers what is the Federal Reserve's role in the overall economy?
Sure. Yeah, it's certainly a timely question these days, isn't it? We certainly hear a lot about them. So the Federal Reserve, at kind of its core, the Federal Reserve is the United States central bank. Okay, and to understand what that is, kind of the history lesson, if you will, is in the early 1900s there was this big financial crisis where the New York Stock Exchange fell about 50% in 3 weeks. It wasn't the Great Depression. It was before the Great Depression. There was another situation called the Panic of 1907, to be very specific. Anyway,
I'm going to write that down. I'm going to look
the
that
elevator
up.
pitch. Yeah, the elevator pitch here is that the entire banking system in the United States was about to collapse. So everyone losing their deposits, everyone's savings account, disappearing, et cetera. And we could go on about this for quite some time, but the punchline is J.P. Morgan, the guy, not the bank, personally backstopped and coordinated the backstopping of the U.S. banking system. So we ended up, surviving, right? And we're still here today. But my point is, this entire 3-week episode really kind of demonstrated to the powers that be that we needed more regulation, more centralization in the country, and we really needed a central banking system, not just this kind of loose collection of banks and so on that were kind of doing their own thing. So fast forward a couple of years, I think it was 1913, and the Federal Reserve gets created. And so the Federal Reserve is created to kind of mitigate some of these problems. And basically what the Fed does, we call the Federal Reserve the Fed regulates the banking sector, okay? And its goal is to try to maintain financial stability throughout the economy. That's probably the biggest thing that I would emphasize. The Fed really is concerned with market stability. Prices up, prices down, that's not really their concern. What they do want is they want to make sure that everything's orderly. They want to make sure that markets are working. They want to make sure that if you do want to buy, if you do want to sell, you can do it. And they have a so-called, dual mandate, two goals. The first is they want to foster the conditions that result in full employment. So they're really concerned with making sure that everyone who wants a job can have a job. And then the second is, again, price stability. So when we experience periods of really high unemployment, when we experience markets that get really, really volatile, for example, that's when the Fed really picks up their attention and they say, hey, we have to do something here. So that's kind of what their focus is. Their job, again, as the central bank, is they're trying to kind of be that moderating presence throughout the overall U.S. economy.
Thank you. Okay, so would you explain to us some of the tools that the Federal Reserve uses to either stimulate growth or to slow it down when inflation becomes elevated? And then while we're on that topic, sort of do they have a target level, as to where inflation would be? You and I had previously talked a little bit about inflation versus deflation. So could you break that down?
Yeah, absolutely. So I'll start with kind of the first half of that too. And really, your question nailed it. They want, sometimes growth goes a little too fast, sometimes growth goes a little too slow. Both of them cause problems in the Fed's mind. So the Federal Reserve, they have many tools in their toolbox, but the biggest thing that they do, kind of the classic thing that we all pay attention to, is they adjust the so-called Fed funds rate. It's kind of difficult to explain exactly what it is because it involves, the esoteric details of bank reserves and overnight lending and all kinds of things that are beyond the scope of this. So what I would just say, kind of big picture, is the Fed funds rate is this rate. It doesn't directly set many rates in the economy, but it influences a lot of rates, right? So when you read headlines, for example, about the Fed, increasing rates, a lot of folks out there, a lot of borrowers or potential borrowers are kind of under the misconception that, rates just increased 25 basis points. That means that my mortgage must increase 25 basis points too. That's not the case. But it does influence a lot of rates, and it speaks to the overall direction of interest rates in our economy. Okay, so what the Federal Reserve does is they increase interest rates when inflation is too high, and they want to slow the economy down, quite literally. And then they decrease interest rates when they want the economy to grow a little bit faster. Again, always with a mind that we're trying to kind of have that Goldilocks moment where we're growing, but we're not growing too fast, not too slow, et cetera. That's their goal. So to kind of get out of the clouds, let me just use a specific example here. So let's pretend that we are going to do a factory expansion. So we're owners of a factory, right? And we're in the business of making widgets, and we want to expand the business. Okay. And I'm going to invest, say, $50 million in this new factory, right? So major investment. I'm not treating it lightly, et cetera. But I don't have $50 million of cash in the bank. Okay. So what do? I go to a bank or whomever, and I want to borrow that $50 million, okay? So right now, today, interest rates are, say, at 5%, arbitrary number, and I'm good with that. That's what I presented to the board. That's what we ran the numbers on. Everything looks good. I'm happy at 5, right? But suddenly, rates are higher. Now they're at 8%, right? Well, what do? Maybe I still proceed with the expansion. Maybe I delay it. Maybe I cancel it altogether because maybe the numbers just don't work, right? So the question I often have with when talking with just friends is just, how does this actually work? Why are they so focused on interest rates? It's that type of paradigm that the borrowing that we do that fuels the future expansion and so on, the access to credit. When we change those numbers, again, I might still do that expansion. I might still pursue that, but I might do it a little later. Or it might tip over into something where now the numbers just don't work and I don't do it, right? And then, kind of the flip side would be, let's again, arbitrary number, let's invert this. So now I'm still planning the expansion, but rates were at 8%, I think is what I said, and now they're at 5. Okay, so they were at 8, now they're at 5. Well, again, what am I going to do? Well, now maybe what I do is I go back to the board and say, look, money's pretty cheap right now. So instead of, expanding by X%, let's expand by Y%, for example, right? And again, all else equal in aggregate, that's going to help the economy grow faster. Okay, my dollar is going to go longer or a little shorter, depending on how much I can borrow. And that applies to the entire economy, right? So the whole thing that the Fed's doing, they're regulating what banks can and can't do. They're helping to influence the overall rate of interest rates in the economy in a lot of different ways. And all that is doing, what they're trying to do in this context is they're trying to, again, kind of get that Goldilocks moment where it's just right, that we have the right kind of conditions that allow for price stability and a little bit of growth, kind of to your point as well.
So it's a balancing act and a very careful dance that they have to walk in order to make that happen, because too far, too fast could cause problems. And I guess too little could cause problems as well. Right. So it's really something. and sort of what are the things that they're looking for as indicators that something is producing a desired result or maybe not? Does that make sense?
I'm sorry, say that one more time. So if something pops up in the market on my other screen.
Oh, sure. So what are the things that they're looking for as indicators that the actions that they're taking are producing the result they'd like or not? So what are the indexes and factors that they're looking at on a regular basis that's reported that gives them a good basis for, what they did and maybe how they need to proceed?
Yeah, so great question. So really they're looking at everything. They're looking at all kinds of different data points. The Federal Reserve itself is run by a board of governors, and they're the ones that kind of set policy. But the Federal Reserve is this massive institution that has regional banks throughout the country. And they have teams and teams and teams and teams of economists and PhDs and academics and researchers that are really evaluating a lot of different things. All that said, the big things that they're looking at is they're looking at monthly inflation reports, so-called consumer price index, for example, aka CPI. They're looking, and that speaks to the overall rate of inflation in the economy. They're looking at things, other metrics called the PPI, the Producer's Price Index, which kind of looks at the cost of goods that go into the widgets that we're making, for example, on the wholesale side. But then the other thing that they're looking at inflation. They're always paying very much attention to that. They're always paying attention to jobless claims and the unemployment rate generally. And then they're looking at how productive the economy was. They're looking at GDP, so gross domestic product. So they're looking to see how the economy has grown or shrank, essentially. And they're taking all these inputs, kind of building a mosaic, if you will, and saying, here's the overall health of the economy. And the Fed's job is not necessarily to look at what's happening today, although they care. What they really care about is what's going to happen in the future. And so, like, there's an old joke that, that the Fed is the one who pulls away the punch bowl and just when things are getting really fun at the party, right? It's like that kind of thing. That's their job. Is the times are good, but maybe are they a little too good? And what we need to do sometimes is we need to slow things down just when things are getting exciting, right? Because again, what they don't want to do is they don't want to have inflation really tick up, because once these trends start, it's really hard to reverse.
So then I guess I asked, how did it get so out of control at this point? Is that really just sort of the perfect storm because of the pandemic being such yeah. Okay.
Yeah, you nailed it. So when the Fed, like today's economic situation is a good example, right? It's a pretty classic kind of example of how we get into this type of situation. All of these things are super, super long lasting, but, let's just use kind of the beginning of the pandemic as a starting point. So if we start kind of in 2020 and we fast forward to November 16th, 2022, today, where do we go and how do we get to this point? Because, honestly, it's worth noting, we haven't had to really deal with inflation in years.
Mm-hmm.
It's been quite some time. I mean, it's always out there, but not something that has been the primary focus of the Federal Reserve. Actually, if anything, they were more focused on so-called deflation for most of my certainly adult lifetime. But anyway, how did we kind of get here today? So in 2020, things were fairly humming along, and then we have this, once a century pandemic in COVID-19, right? And the entire economy gets disrupted at that point, right? No one knows what's going on. We're all in lockdown. No one knows how long this is going to be or where it's going to end, and so on. But what happened, one of the byproducts of that kind of lockdown is, we certainly were spending less, right? Because again, you're uncertain what's going on. You weren't making major purchases, even just little things like going out to dinner or whatever it happens to be. We weren't doing that. So statistically speaking, from an economics point of view, our savings rate went up as a country, as borrowers, as individuals, and so on. Okay, so now, fast forward, pandemic starts to wind down, thankfully. Lockdowns are lifted, and so what's everybody do? I don't know about you, I went out to dinner, right?
Sure.
That vacation I didn't do, right? I did that, and so on. And you feel like celebrating a little bit,
Yeah, it's like, I gotta get out, yes,
great.
liberating.
Exactly. Well, it turns out, you've been saving money for all these months, right? And so you have a lot of pent-up savings. So plus on top of that, what did the government do? The government wanted to make sure that that everyone was taken care of, so there was a stimulus, right? And yes, a lot of people really counted on that, but some people didn't, right? Some people, it was just basically found money, and so now we have a little bit more savings. We have a little bit now from the government, right? That's an economic stimulus and so on. All this contributes to you hear supply and demand, right? Well, demand really starts to increase, right? So on top of this, though, so now demand's increasing, saving rates are up, right? But then you also have global supply chains. That's probably the other big piece here. So a lot of things aren't just, as we all know, like a lot of things aren't just made and manufactured in a small town in the U.S. that's totally self-sufficient, right? Things are manufactured and imported and so on from all over the world. Well, whatever we did in the U.S., other countries did things a little bit differently. Everyone reopened at different paces. And so when you have these global supply chains that are all interconnected and so on, it just takes one small thing across any of these that really disrupts things. So you have massive demand, you have supply getting severely disrupted. What happens when you have high demand and low supply? Well, prices start to go up, right? So the Fed looks at all this and they say, okay, well, if I'm being honest here, this makes sense, right? If I'm putting my Federal Reserve hat on, there was always going to be extra demand. There was always going to be supply disruption. But that's not necessarily like fundamental or structural in the U.S. economy. The word that they kept using was transitory. This is just a temporary kind of thing. Like, I see that this is happening. I see that inflation's picking up. But all of this is going to level itself out. That's what the Fed kept thinking and very publicly saying, is everything is going to calm down eventually. And then you start getting other things too. On top of this, you have the geopolitical situation in Ukraine and Russia. You have the energy markets getting disrupted and so on. And all of this goes together. And this inflation that they kept looking at and saying, nah, it's just temporary. Yes, this is going to pass. Nothing to worry about. Now it becomes embedded. And I guess kind of my long rambly point is when we're talking about the structure of the U.S. economy, inflation expectations, the idea that I'm personally thinking that prices are going to be increasing in the future, it takes a long time for us to kind of change our minds about that. We have this pesky way of always looking forward. And so what the Federal Reserve has to do then is they look at all this and they say, I need to convince the market that inflation is declining. And that's kind of what they're doing today, right? And they're trying to slow down the economy. They're trying to raise rates to, again, just kind of slow everything down so that we kind of reset and get back to a 0 point.
So at its simplest level, if you think about it, it's like, so as they raise rates, that increases the margin at which so if somebody's borrowing at a higher level, then they've got to almost right, because now their margin is compressed. So then that translates into the cost of their goods, right? Yeah. Yeah.
Yep.
Okay.
Precisely.
Yeah.
Or, to use an example germane to all of us, if we just look at the housing market, right? The more that we increase rates, for example, the fewer options that I have. At the beginning of 2022 and a lot of 2021, we had complete bidding wars in the housing sector. Right? You'd list a house like the anecdote that I would share. I know we all have dozens, but the anecdote that I would share is my in-laws, my brother and sister-in-law. They were listing their house down in Austin, so very, very hot market. And what they were advised to do by their realtor was just get out of town for the weekend, go on a little vacation or something like that. They had something like 30 showings over that weekend. They got 15 offers, and they sold their $400,000 house for $85,000 over asking. Right. Well, again, the Fed looks at that and says that's a little out of hand. Right. And so what are we going to do? Well, we're going to try to raise rates to cool things off a little bit. Right. It doesn't help anyone that we have these kind of bidding wars and so on, but that's kind of where we're at. So they look at something like that and say, okay, this is evidence of a market that's not functioning great. This is something that needs to cool down a little bit, and we're going to raise rates to slow people's impulse buying on these houses and so on to kind of get back to a more stable point.
I mean, if you think about it, investing in its core, it's like you want a slow, steady rise. You don't want these major ups and downs. I mean, that's never, healthy. I certainly have a similar story. I can think of friends of ours that sold their house. And I don't even know if it ever hit the market, actually, with 30 offers, 100,000 over list. And it was somewhere in the $900,000 price point. It was insane. It was absolutely insane, and certainly, for those of you watching, when you're in that sort of space, it's like, what people are paying for the house at that point in time, it's not worth.
Yeah.
Okay. You know what I mean? Like it based on the bricks and mortar and the physical property, it's not worth that. It's just what somebody is willing to pay at that point in time. So I guess I didn't necessarily think that which is foolish, but I wasn't thinking that they were like looking at that, but that makes sense why they were like, whoa, this is not good. We need to get a handle on this particular piece. And, I was thinking about it when you were explaining it, when I was originating. At one point in time, I certainly offered and did quite a few ARMs, not the pay option ARMs that caused the disaster, but regular traditional ARMs that made sense based on that particular borrower's financial position and goals they wanted to achieve. And, many people were always, cautious of them. And when I was to explain them, I would go back to this. I had this sort of dialogue about, what your sort of worst case scenario is in the first adjustment and then over the life of the loan. And I always included inflation as a component of that, of where that's not too probable that it would actually get to that point. And now it's like the dialogue needs to change because it's an entirely different situation as we sit here today. I wanted to ask something before I get into the next question, just because you brought that up recently. And that's certainly something that's been in the headlines over the past couple of days is CPI. So we had, a CPI report come out lower than the market had expected. And that caused the single lowest drip in or reduction in rates since 2009 in one day.
Yeah. I was very stressed that day. That's right. Yes.
Yeah, I can imagine. Yeah. So can you explain to us why, like what's behind that, and what was the perception that it would cause that sort of a reaction?
Yeah. So what I would say there is, so markets are always forward-looking. Markets are the collection of a whole bunch of tens of thousands, millions of different viewpoints. Okay, and markets love certainty. And to emphasize the opposite of that, markets hate uncertainty. Well, right now, what the Federal Reserve is trying to do, so we have this inflation problem, right? And again, like long story short, it is very hard to nip that in the bud. It's hard to convince the market, the world, the economy, that inflation is declining. And the other thing is, So every time a Federal Reserve official gets in front of a microphone, what they're absolutely pounding the table about is they're trying to say, like, you gotta listen to me, world. We are committed to fighting this inflation. And oh, by the way, we have the strength and courage in our conviction to see this through. And that's the big thing, right? Because the longer this goes, the higher they raise rates, for example, now we start to see, for example, the economy cooling off. Now perhaps we start to see the unemployment rate going higher, right? The longer this goes, from a big picture point of view, right, that's good for the health of the economy. But day to day, it's not good, right? It's difficult. It's difficult to be the person or group of people in the chair who are causing a policy that's causing harm in the economy. And they start getting pressure from everybody, friends, family, politicians, and so on, right? That are saying, oh, the bunch of knuckleheads over at the Fed, they don't know what they're doing, right? And so what the Fed needs to convince the world of is that they're saying, like, listen, we know what we're doing, we see the pain, it doesn't matter, you're all going to thank us down the road, right? For example. But my point is, it's a very difficult thing for them to again, kind of have that courage of conviction to stick it out. It's very easy to say, no, we're good. We've accomplished this. Here's kind of where we're at. Well, the reason I go into all this backstory is no one knows when the Fed is going to stop raising rates. There's lots of different conjecture out there, lots of different economic scenarios that people can go through. And so whenever we start to see inflation decline and decline meaningfully, what that means is that all else equal, the Federal Reserve might start to slow down the pace of their rate increases, for example. And so, again, markets are forward looking. So when we see, for example, a CPI report that is below expectations, when we see Federal Reserve officials saying, I don't know, are we going too far too fast, for example, then markets, people who are kind of speculating that they're going to have to decline at some point, say, see, I told you, this is what I expected to happen. I better buy as quickly as I can because I don't want to miss this, right? And so you have these, it's kind of the same, you ever see a headline that it's like, so-and-so company reported earnings, record revenue, stock down 30%, right? And the reason is because what they said, not what happened in that quarter, but what they said in the future is going to happen, their forward guidance, right? And it's always one of those crazy headlines, record earnings, record revenue, stock down 20% or something like that because of what they said otherwise. It's kind of the same thing here. Inflation's still high, but it did decline. And because of what they said and what we all expect, the market rallied accordingly, right? So it's a really, kind of sensitive time in the market. It's kind of, we're closing in on an inflection point. Maybe we've even hit it, hopefully, where, what we're going to see, what everyone's hoping is they're trying to figure out when is the Fed going to feel confident enough that they can stop the rate of increases, that they can let things level out, and eventually even decline rates. And so no one wants to get behind that.
And that would be that's calming. So then it reacts according to that level of calm. Yeah,
exactly.
Yeah.
Exactly.
Something too that you and I had talked about a couple of weeks ago, and regardless of the side of the political aisle that you happen to fall on, the fact of the matter is when the whole student loan bill was put out there huge percentage of student loans was forgiven, that's a huge injection into the economy. And we were talking about, it's like, well, isn't that a sort of undermining the central bank? And it does, because it's still putting money out there that then people that, now had this money that they would have spent for this, that they then go and put towards this and then could drive things up. It's really interesting how that, all sort of plays into it. And I don't think people think about it to that level. They're looking at, that's a really good thing, but they're not looking at it, from the flip side of that, I think one of the biggest things, like I said at the beginning of our conversation, was it's just people are just scared to buy, and it's sort of that they're forward thinking. Well, if things, it's almost kind of that I guess the idea of deflation, and that, well, if values are going to go down, then I'm just going to wait, or if interest rates are going to go down, then I'm just going to wait. So, how does an investment in real estate enable a buyer to diversify their overall wealth position? It's something that when I'm having a conversation with a loan officer that I coach, is like, we have to help our borrowers, to understand. Even some of our referral partners understand that, it's time in the market, not timing in the market, because we can't time a market. Right. And that's been shown year over year over year. If you look at equities, if you look in real estate and you just go backwards, that it's time in the market that produces the greatest level of result in terms of what you appreciate versus timing and just happen to know when the perfect time is, because nobody knows that. Would you speak to that?
Yeah, exactly. I mean, it's the old joke, but it's so important that, no one has a crystal ball, right? You hear that all the time, and it's true. We have no idea, what's going to happen in the future. But it is worth noting. I mean, there's a few different ways that you can look at it, but let's look at it from the perspective of someone who perhaps is renting as opposed to owning. It is, regardless of, kind of everything that we're talking about, it is true, of course, that rent is not helping them to build equity. It's not helping them to build wealth. There's a lot of positives about renting, right? It's the kind of thing where, if the furnace goes out, I'm not on the hook for it. I have a lot of flexibility. I'm not tied down. That's all positive, but we're not building equity. As a homeowner, a portion of that monthly payment is, of course, going to pay down your principal and building an asset over time. From a wealth management point of view, it's also worth noting that when we talk about things like inflation, classically speaking, one of the very best hedges, something that can counteract inflation, is actually home ownership. Home prices, generally speaking, tend to increase in periods of inflation and so on. And so, that's something that's worth noting is, what can I do about this inflation? Well, again, typically what we're looking at a home price that is increasing as well. You mentioned ARMs, and some folks have ARMs and so on, but a lot of folks, of course, still are in fixed rate payments. The other thing that's worth noting here too is, in an inflationary environment, yes, of course, milk and eggs and gasoline and so on are increasing, right? But one thing that's not increasing is your mortgage payment if you have a fixed rate mortgage, right? And so while other things are increasing, and so on, it's worth noting that you're locked in as opposed to perhaps at the whim of your landlord from a renting point of view. So all those things I think are worth emphasis. The other thing is from a home price, okay, that's great, but what about the fact that I'm buying this home that I'm a little worried is overvalued, for example. As you said, I certainly don't have a crystal ball. I don't know what's going to happen with home prices and so on. But there's two things that I would say. The first is the purchase of a home is typically not a short-term type of investment. When we are buying a home, the market might ebb and the market might flow, but generally speaking, we're looking at a long-term kind of thing, and we're looking at a long-term rate of home price appreciation throughout the country. Folks that were buying, in the 80s, for example, 30-year mortgage, right? Well, 30 years from now, what did the value of your home do, right? Even folks who were buying in the early 2000s, when we saw a housing crisis, with the exception of some of the very frothiest markets, the vast majority of those folks are, again, positive, even if they did buy toward the top of the market. The other thing that I would just say that's my own personal view on all of this too, it's just worth noting, and there's statistic after statistic about this, we are dealing with a structural housing shortage in this country. The rate of homes that have been built in the last 10, 20 years has not kept up with the growth rate of the population. It just is. And so does that mean that it's a panacea and things will always go higher? Of course not. But it is worth noting that when you're dealing with a structural housing shortage, when you're dealing with the millennial generation who by and large purchased homes later in life than their parents, when you're dealing with this kind of pent up demand and so on, it does provide a little bit more of a mitigating factor when we talk about home prices potentially falling, right? Well, okay, fine, home price falls a little bit if it happens that way, but you still have all these structural long-term things that are in there as well. So again, that's certainly not to suggest that home prices can never go down, but it is to suggest that this time perhaps might be a little bit different. But the last thing that I would say, actually, just on this note too, because I can just never resist bringing this up, is one of my favorite topics is behavioral finance, the psychology of how and why we do what we do. The simple example would be, would you rather buy something when it's increasing in value, or would you rather buy something when it's decreasing in value? well, I don't know about you, I'd rather buy something cheaper, right? But at the same time, psychologically, that's really difficult for us, just for all of us. We'd rather see something increasing in value and saying, I don't want to miss out. Whereas if something's decreasing in value, psychologically speaking, what goes into our head is, well, gee, what if it gets worse, right? Again, no idea what's going to happen, but it's worth noting that's a bias that we all share. And so it's just kind of worth taking a step back and saying, well, gee, if I can buy this house today outside of a bidding war and, for a little bit less than I anticipated, that's a good thing, right? And so on, as opposed to, getting caught up in it and kind of going from there.
There's something that I when I teach classes on this, I will generally look for data behind things to support what I'm teaching. And I came across a study in that the Federal Reserve has done, and it seems to be almost pretty much the same every time they sort of evaluated it, in that the wealth, sort of, you're looking at the wealth of a renter versus a homeowner. The wealth of a homeowner it's certainly a wealth strategy, right? The wealth of a homeowner is about 44 times, I said 44 times that of a renter. So it was somewhere in the area of the average net worth was something like, I want to say 255,000 for a homeowner versus 6,900 and change for a renter. It's just something that I felt that was really worth noting, in the context of our conversation. That, along with the fact that, if you're paying rent, essentially it's 100% interest that you're paying on that, right? Because that's something, and you're basically making somebody else wealthier, not yourself. Okay. So, it's just certainly things to take into consideration, and certainly, having the fact that we have all these sort of products that help you to get into a home with little, and sometimes, no money down really helps to give you that leverage that you need in order to achieve that wealth that some folks, can struggle with over time. So it's certainly a wonderful tool in that way. James, would you speak to, and you did that already slightly, but kind of like, can we just share with our viewers how sort of this is, and maybe in terms of this being a correction versus a crash? And then maybe can we talk a little bit about how in the previous crash, that happened, maybe 15 years ago or so, is it that long? 14 years ago, the toxic loans that were the major component of that versus that don't exist in the environment we're here right now.
Yeah, so starting with kind of a correction versus a crash. So there's a relatively formal definition for this. So corrections are situations where the market declines by more than 10%, but less than 20%. So that's the
more than 10, less than 20. Okay.
Yeah, that's right. So call it a 15% decline, for example. Whereas a crash is going to exceed that. For example, the granddaddy of them all was the Great Depression. That was 89% over 3 years. So that was aggressive. But something that's a little bit more recent for us, the stock market in 2020 sold off over 30% in a month. There were 3 days where the market was down 8%, 10%, and 13%, respectively. And that was more of a crash. For example. There have been many financial panics and so on throughout the history as well that kind of went from there. In the case of COVID, like I said, that was a situation where none of us knew what we were getting into. What was going on in the world, uncertainty, fear. All these things are things that go into the idea of a crash, where we start losing our kind of rationality, and we start being irrational, and we make panic decisions, impulse decisions, and so on, right? Whereas a correction, again, kind of that 10 to 20% range and so on. Generally speaking, what we're talking about here is the market's gotten a little bit ahead of itself. Valuations are a little high. Folks start to sell. Other folks say, hey, this is not such a bad idea. We are a little bit ahead of ourselves. And it just kind of snowballs from there. I did look up a stat, though, the other day that since 1979, there have been 24 stock market corrections, and only 5 of them resulted in so-called bear markets, which are declines of less than 20%. So to your previous point, 4 out of 5 times when we have these quote unquote corrections, we end up actually, stronger for it. And I would tell you as well, from kind of a big picture perspective, from a kind of classical economic theory perspective, these are things that we want, right? We don't want just things to go straight up as much as we want that, I suppose, as much as I want that, straight up with no dips. That's something we would all like, right? But that's not really the way the world works.
Right? That's a psychological. Yeah, sure.
Exactly. And that's just not the way the world works. And so what happens is, we start at, just pick an arbitrary number. We start at 100, we go to 130, we decline to, 115, we rally from there again, right? We kind of flesh out and find a firmer foundation, right? So again, when we look at this kind of situation, 4 out of 5 times that we're talking about a correction, we end up generally speaking higher for it and better for it. And so when we look at things like, the housing market, that has a really big deal. Again, back to, okay, a good exercise to think about is, why is it different this time? How is it different this time, right? And to your point, probably the biggest other thing, I mentioned kind of the structural housing shortage, which is certainly a thing. But the other thing is, lending standards are dramatically tighter. We're dramatically tighter with credit than we were 15, 20 years ago. The types of loans that put a lot of borrowers into homes they couldn't afford, so-called option arms and so on, they don't really exist anymore. And what we haven't seen this time around in the cycle, in the rate cycle, is we haven't seen the kind of, for lack of a better phrase, like irresponsible lending that we saw the first time around. When you talk about an option arm where, you're basically giving a product to a consumer that only will work if the market continues to rally, that you are certainly setting yourself up to failure. And we can say that with the benefit of hindsight. But this time around, we really haven't seen that type of behavior. We haven't really seen, the vast majority of mortgages are pretty conventional at this point. Fannie, Freddie, Ginnie products or portfolio products that are not particularly exotic. Kind of everyone learned their lesson, at least to a certain extent. Doesn't mean lenders never, go under. Doesn't mean that people can't make bad loans. But it certainly means that on the whole, across the entire economy, we're seeing dramatically less of that this time around than previous.
Okay, thank you. So, previously, not only basically people got into a situation where, like you said, they were set up to fail, and their homes then became less than they were worth, or they owed more than what they were worth, right? And then they're in a position where, what are they going to do in that situation? They're just going to let it go, right? And then that happens on a greater scale, and then you have all this influx into the marketplace, and then it's just like a domino effect where it continues to plummet. And that even said, even with that, people at that point in time, we're still, if you still look at the overall, people back at that time are still up now. Even the ones that were at one point underwater, if they hung in there, they're still up now. So that really speaks to, how the cycle does over time generally works itself out to, one of abundance versus the lack. And I do think it's, important to mention that, because that's certainly something that should be something that people, consider. So just to sort of wrap up our conversation, what do you feel are like a few things that maybe people could start to, not that we have a crystal ball, of course, but that may need to happen, or that we start to see take place, that might be signs that we might go, okay, maybe we're heading towards the path that is going to be calming and in the direction we'd like to see the economy going?
Yeah, I think it's of course a great question. I think really it starts and stops with inflation. That's I wish it was a more exciting answer, right? But it isn't. Inflation remains the focus of everything. The Fed is going to continue talking about the need to slow down the economy. The Fed's going to continue talking about raising rates and so on, until they are satisfied that the overall rate of inflation in the country is declining. And again, to be candid, that's going to be frustrating for all of us to watch because every time a Fed official gets in front of a microphone, you're just going to want to tackle them because you're like, I get it. I know you said this last month, but they're trying to, again, convince the market that they have the courage to see this through. So we need to see inflation reports on a monthly basis starting to decline. We saw that with this previous one, which is good. But one print does not get us out of all of this.
Right.
So we need to see
over a period of time.
Continuation of that.
Okay.
So we need to see that. We need to see the rate of growth in the economy slowing down just a little bit too. It's one of these counterintuitive things where good news is bad news is good news is bad news kind of thing, where it's like where you see strong earnings from from a company, and you say, well, that's great, and then you say, wait a second, but that means that the economy is going okay, but that means, and you kind of go down this rabbit hole and so on. So we need to see. We want to see the economy slow a little bit. It's not the most pleasant thing, but we want to see unemployment increase a little bit, right? We want to see, again, just generally speaking, the economy cool off a little bit, and that's a good thing. It's in any economy, we have these expansions and we have these so-called corrections. The correction sets up the next expansion, and we kind of go from there. So we need kind of that healthy, from an economic point of view. We need that healthy, kind of natural, kind of classic contraction where we again, have a little bit of short-term pain for a longer-term gain. The second thing that we really need is kind of goes hand in hand with that, which is volatility. Right now in the mortgage market, we're incredibly volatile. You can just take my word for it. By definition, mortgages don't like volatility from a valuation point of view. So what we need is the market to stabilize a little bit. And again, those two things kind of go hand in hand. The reason that we're so volatile is because we're all hanging on every economic print because we want to know what the Fed's going to do and if they've actually been able to slow down inflation, right? So it's natural, again, that as we kind of go through this part of the cycle, that we're going to be volatile as we try to find, a floor, try to find a bottom, try to find, certainty. Again, markets love certainty. When I have certainty, I can invest and I can make a decision. When I have uncertainty, I feel a little bit gun shy, right? And so what we need to see is some more certainty, some more clarity, and to use another word that ends in ity, less volatility, right?
So certainty, and clarity, less volatility.
That's it. We need 1, 2, 3. Yeah. And then from there, what we need is it all kind of culminates in the idea that, we need additional buyers to step up. Big picture, very big picture. The Federal Reserve themselves has been the buyer of choice of pretty much all mortgages for the last decade, right? They did this to help support the economy. As I said, they have a lot of different tools in their toolbox. But right now they're on the sideline, and that's a really big deal. They want to be on the sideline, by the way. That we've had a perfectly functional mortgage market for years and years and years without the Federal Reserve. They don't want to be in the business of buying mortgages. But what that means is when you have this giant monolith like the Fed that moves out of the market, you need, a buyer to step into that void. Sure. And so who's going to be the buyers of choice and so on? We need our banks to come back. We need foreign governments and money managers, and we can go all into that detail. But my point is, when we see declining inflation expectations, when we see volatility subside, then what we need to have kind of the classic buyers stepping up and returning a little bit more. We're starting to see that a little bit, but that's, again, one of the bigger things that can continue to happen for sure.
So private capital is healthy. We don't want the government to be in the, essentially, that's not a sign of something healthy where the government is having to go in and provide that liquidity. We want the private capital to be in there. That's actually what we're going for, right? Would you, go ahead, James.
No, yeah, that's it exactly. Yeah, just agreeing with you there.
Yeah. So before we end our time together, there was something that you shared with us recently regarding First Home's role in the marketplace over the past 5 years. And there were some pretty, interesting and very things that I thought that, we really should share with those that are checking out our video today. Would you mind sharing some of that data with us?
Yeah, it's really powerful stuff. Since 2017, so recently, what you're referring to, of course, we just introduced a product we're calling First Home Advantage that is really all about first-time home buyers. And the elevator pitch being that if you're a first-time home buyer and your income is below a certain threshold, it's actually pretty substantial in some areas. There's some greatly advantageous pricing in terms of rates and prices that's available to you. And really for us, that doubles down on, kind of something that we're already quite good at here at First Home. Since 2017, we've originated more than $9.2 billion of loans to first-time home buyers. That's more than 29,000 folks who we've helped purchase their first home.
That's amazing.
2022, it's a tough market, right? But we're still over 3,000 borrowers with nearly 2 months to go, right? And, in 2020 and 2021, it was more than 1.8 billion in both years, individual. So my point is, in these types of markets where things are a little bit challenging, where things are moving, quite a bit, it's nice to be partnered with certainly the right folks. And that's something that we're, like I said, we're already quite good at, but our hope and certainly our strategic direction as a company is to really double down on that. So again, that's what the new program is, First Home Advantage. And, not to be too forward looking, but we've got a couple things that we're working on that'll add to that in the coming months as well.
And we'll be excited to hear about that for sure. So we certainly appreciate your time, your expertise. I could sit here and talk to you for hours. Is there anything else that you'd like to share with our listeners that you think of that we didn't cover that you feel is important for them to know? Yeah, first of all, thanks for taking the time as well. I always certainly enjoy talking about any of this and, always here to help, right? What I would say is the anecdote that I would share is, as we look at the articles that are getting written right now, and as you see, rates have declined a little bit in the last week or two, and that's good. But, we certainly are the highest we've been in quite some time. And I was teasing my father the other day. I saw him over the weekend, and whenever he's a realtor, and so whenever the subject comes up, yeah. Must be make for interesting dinner conversations around the family dinner table.
I swear, every time I could set my watch to it, the next thing that comes out of his mouth is, you kids today, you don't know how lucky you have it. Back in my day, with 18% interest rates, and so on. And so, what I remind him is I'm like, well, yes, but, and so on, like rates are certainly higher than they have been and so on. But what I would say is let's not go back to the 80s and let's not have, to tease my father, let's not have a patronizing comment from one of the old timers, right? What I would say is let's look at, the 90s, let's look at the 2000s and so on. Those were two wonderful decades of economic expansion, and we saw rates generally in the sixes. The economy was great. Home prices were appreciating. Like it's everyone that bought back then, right, is feeling pretty good about it today and so on too. So what I would say is, I think that as we talk about, again, kind of the wealth impacts of homeownership, as we talk about the diversification benefits from our own portfolio and so on, when we talk about kind of the relative value, look, I hope we get back into the 4s and 3s and 5s again too, but if we level out and we stay kind of in this type of environment for a while, that's fine. We can do just fine as consumers. We can do just fine as an economy. And so what I would just kind of say is, as we normalize here, if you're talking to someone who's interested in purchasing a house and they're like, well, gee, but aren't rates a little high? Okay, again, my father's not entirely wrong, and it's important to note that what we saw recently was the exception and not the rule. And certainly as we look to all the benefits of home ownership and so on, don't let a 6.25% interest rate scare you off.
And by the way, as rates increase, so do your savings rates, right? Because if rates are, super low, as they've been artificially low over a period of time because of quantitative easing and all the other things that needed to be dealt with the pandemic and stuff like that, then that keeps the rate of what you can save. If you think about money markets, CDs, savings accounts super low too. So, there's a relationship there that, that you're benefiting on that side too. That's worth noting. So folks, if you happen to be, renting, or you have a need for your family that, may require a housing upgrade, or maybe your kids are gone and off to school, and maybe you need to make some changes in terms of, downsizing, we encourage you to just connect with one of our loan officers and sit down and have a discussion with them. Help them, they will evaluate, they will listen, they will really seek to understand what you want, what you need, and they will craft, a plan that is unique for you and for your future to help you achieve those goals. So we appreciate you spending a few minutes with us today. We certainly hope that this conversation gave you some clarity and some insight. And if you're so inclined, we would love it if you would share, with a friend or a family member that you believe might benefit from, some of the things that James educated us about today. So thank you so much, James. Everyone, be blessed, and we'll hope to see you again real soon. Take care.